to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello, everyone. Welcome to another episode of On My Way to Wealth. Today, we're going to be talking about the fun topic of life insurance. Not really so much of a fun topic. A lot of people really don't like to talk about this, have this conversation pretty often with my clients. But I understand it's a little morbid to think about your own death, right? But, unfortunately, it will happen one day, right? So we might as well be ready as much as we possibly can and help our survivors, our children, etc., our spouses, who are already going to be dealing with a lot of grief to be best protected as possible, right? So let's talk about it a little bit. Before I get into whether or not you should or shouldn't buy life insurance through your group employer benefit, let's talk about some basics of life insurance first, and then we'll dive in. So let's talk about the basic types of life insurance. The very first one that is the most common, the cheapest, the very, very basic most form of life insurance is called term life. And you literally purchase insurance for a specific term, typically ranging anywhere between 1 to 30 years. So for example, we're in the year 2020. If you bought a 20-year term, it will expire in 2040. So you will be covered for that specific term that you purchased it for. Now, because you're only buying life insurance for a specific term, and it doesn't have any other types of features like cash value or anything like that, it's like straight life insurance, this is typically going to be your cheapest form of life insurance. So what is the next option? Let's say if you wanted to get a little, say, fancier, and you wanted to buy something that maybe lasts you longer, for example, for your whole life, as opposed to just a term. Well, pun intended, there is whole life insurance. And whole life insurance is exactly that. You're purchasing insurance for the duration of your entire life. And what that means is that at some point, one way or the other, your beneficiaries will get the death benefit. Now, because of that, whole life insurance is going to be a lot more expensive because if you think about it, if you buy insurance for 20 years, there's a very likelihood that you will outlive that term. Let's say you're 20 years old right now, or say you're 30 or 40. Say you're 40 years old, you buy a 20-year life insurance right now, or even a 30-year life insurance, it's going to expire when you're 60 or 70. Very likely, you might survive those 30 years and then end up just spending the premiums for all those years and nobody gets any benefit out of it, right? Which is why it's cheaper. But if you purchase a whole life insurance, it's permanent. So it's going to be with you for the rest of your life. So that death benefit will be given to your beneficiary at that point, right? So it's going to be a lot more expensive. Another feature that whole life insurance has is a cash value option, which is a tax-deferred savings account, basically, where the cash value accrues interest at a predetermined fixed rate. And then each month, a certain portion of your premiums will go into the cash value of the policy, which offers a guaranteed rate of return. So the cash value grows over time. So not only is there a death benefit, it's also a savings account within your life insurance that you can contribute to. Now, because of this and the fact that it's permanent, they can be significantly higher premiums than the term life insurance. So you might have heard a term where people say, and again, pun intended, people say buy term and invest the rest. The reason to say that is because when you take into account a term life insurance policy and you compare it to a whole life insurance policy, the premium could be significantly higher, right? So what some people say is, hey, why don't you just buy a term, cover yourself for X amount of years, and then the difference in premium, you can invest that. But obviously that comes with some risks because first of all, you're buying term, which is going to end at some point. And number two, it's not guaranteed that you're going to make money in the stock market if you invest it likelihood you will over time, but it's not guaranteed. So obviously it comes with some risks. Now, let me give you a little bit of other options that are available just so that you have an idea. There's also universal life insurance. This also has a cash value, just like whole life policy, but your premiums go toward both the cash value and the death benefit. And the universal life policies can change the premium and the death benefit amounts without you having to get a new policy. So it offers that extra layer of flexibility where you can increase or decrease your death benefits within some limits of the policy. And obviously, if you're trying to increase the death benefit, is going to be something that would require underwriting again and things of that sort. So something to consider. Then you also have variable life insurance. And what this does is it's similar to life insurance, that it has cash value and it's also permanent. But instead of having a savings account within the policy, what this is going to do is give you an investment account inside the policy, kind of like a mutual fund type of investment account. So when you pay a monthly premium, part of it goes into this investment account. And then over time, it is likely to grow because it's being invested. However, you can also lose money because it depends on the market, right? So that's another added risk. Some people like that feature because they can both have life insurance that is permanent and they can invest, but you are limited in when you can invest. You can't decide what investment the money goes into. It's already predetermined. But some people call it a super IRA because you can just put money on a tax deferred basis as if it was like an investment, individual retirement account. I'm trying to keep it as simple as possible, right? Just so that you understand some of the basics. Let me tell you about one more policy. It's the variable universal life insurance. So what this does is kind of like combines the whole life and the universal. So, depending on how you look at it, it combines either the best or the worst features, right? So you can adjust the premium and the death benefit while also investing the cash value in the policy's cash value. So it gives you even more options. But again, that invest in the cash value can also lose money because it is variable and it's based on stock market returns. There is also a simplified issue life insurance policy. This is something that typically people with serious illnesses or maybe they're a little older usually buy because it doesn't require a paramedical exam. So you just go through a series of health questions in a health questionnaire, and then they issue the policy without you getting a health exam. So, it's sometimes a good option for some people that are older or have some serious illnesses. But as you can imagine, this is going to cost you significantly higher than, say, a term policy. There's also guaranteed issue life insurance policy, which basically takes the concept of simplified life insurance, and you don't even get the health exam, and you don't also do any of the questions on the health questionnaire. But as you can imagine, this is going to be a pretty high premium. And then the last one I want to tell you about is the final expense insurance, and it's exactly what it sounds like. Some people that just never got life insurance or got term and then outlived their term just buy final expense insurance because this covers your final expenses like medical costs, funeral, cremation, things of that sort. So a lot of people don't want to burden their families with this. Maybe they didn't have enough money saved, and then they go ahead and buy one of these policies. They usually range between $5,000 to $25,000 in coverage. So it's not like you can get $1 million for one of these policies. It's just enough for covering your end of life expenses. So now let's get into whether or not you should buy group life insurance from your employer or you should get your own. So the answer is it depends. You can certainly take advantage of the group life insurance policy that's offered by your employer. And I would say there is a portion that is automatically paid for by your employer. So why not take advantage of it? Might as well just do it. Now, here are some of the limitations of this. Typically, your group life insurance gives you an option to purchase some additional amount. And that might be, say, like 2 times your salary or 1 times your salary, which is great. But for most people, that's probably not going to be enough coverage. So you don't want to have a situation where your only life insurance is through your employer for, number one, it's going to be possibly not portable. It depends on the contract, but typically you may not be able to take that coverage with you if you were to lose that job. So right now during COVID-19, a lot of people have lost their jobs. They have also lost their life insurance that they had through their employer benefit. They have also lost their health insurance they had through their employer benefit. So you don't want to put yourself in that type of situation. So yes, is the employer offering you a group life insurance policy? Absolutely take it. Do you have the option of buying one-time salary, two-time salary? That might be a good option. Go for it. But consider the fact that you might lose this coverage. So you want to read the fine print, understand the policy, sit down with your financial planner, make sure that you know the benefits and the risk as well. Number two, if you buy the additional coverage, it might be more expensive because when you think about it, the group life insurance policy is not based on your medical history. So it could be a benefit, for example, if you have health issues or you're older, because you're not required in most cases to go through some sort of medical underwriting. So it's either minimal or no medical. So you're covered under a group plan. But at the same time, you might also be overpaying because if you think about it, if your coworker is a smoker and another coworker has terrible health and your perfect health, you're all going to pay the same under this plan because it's covered under group life policy. So something else to consider. Sometimes you might be able to just go on your own and get your own term policy and might get a cheaper premium just because you're in good health. So something really key to keep there. Obviously, it has the good benefit of having income tax-free death benefit, just like the term life would, minimal, no medical underwriting, and also has the potential to add additional coverage for your dependents, which is another great feature. A lot of employers have that option. Now, one of the downsides of this also is that you might not be able to have your premiums guaranteed because the group life insurance premiums are typically based on the company and the contract that they have. So it's subject to potential increases later. If the insurer raises the group premiums and passes the increase to the employees, then the participants in the plan can be impacted as well. So another thing for you to consider. So definitely sit down with your financial planner, review your coverage, and use the group term life or the group life insurance policy that is offered through your employer as part of your overall plan, because 2 times your salary might not be enough. And also you might end up without that job one day. And think about it this way. Imagine you by yourself, you start a job when you're 30 years old, you work there for 20 years, and you had this group life insurance, and then you end up being 50 years old and you get laid off. Well, now you have to go in the market and buy yourself a new policy for yourself at age 50. And a lot of things can happen, right? Maybe your health might not be as good, et cetera, and you might be paying a much higher premium. So if you were able to buy your own policy when you were much younger, you'd be better off. So definitely consider it as the overall package. Consider whether or not it's portable. So that means that if you leave your job, can you take that policy with you? And also consider the fact that whatever amount of salary coverage they're offering might not be enough coverage for you. So you may want to do a combination of both, maybe have your group life insurance policy and purchase your own insurance. Now, whether or not you do term or whole life, it's something that you should sit down with your financial planner. A lot of people say buy term and invest the difference. Some people say buy whole life. It depends on what your goals are. Do you want to leave a legacy? Is it just to cover a specific period? Sometimes I meet with clients that are young and they just had their first child, so they buy life insurance and they want to make sure that there's enough coverage there to cover, say, 30 years so that the child has, if something were to happen to one of the parents, the child will be covered. There'll be enough money for keeping the roof over their child's head, first of all, and then there'll be enough for putting that kid through college, for example. But then that's it. They're like, all right, I'm comfortable with the fact that if after 30 I die and my child doesn't have their life together, then that's on them. So it depends also on your values, right? So think about it that way. You might just want to get a 20 or 30-year policy just to cover a specific period. Other people save and invest so much money during the lifetime that when that term policy is over, they no longer need actual coverage from a policy. So that is completely fine as well. You might do a good enough job of saving and investing over your lifetime. So let's say you buy a 30-year policy, you can save and invest over 30 years so that by the time that policy runs out, you don't even need life insurance anymore. Some people still get it, or they get the whole life because they want to, in addition to having enough to cover if they died, they want to leave a legacy. They want to leave money to charity. They want to cover estate taxes, things of that sort. So there's many reasons why people get life insurance. So just keep that in mind. If you have any questions, send me an email at luis@onmywaytowealth.com. Thank you for tuning in. And I'll be very happy to see you in the next episode. Thank you for listening. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.